dangerous assumption most investors make. If a stock price is climbing, the company must be doing well. Well, that's wrong. And this fallacy has destroyed billions of dollars in investor wealth. According to research published in the American Cognitive Review, systematic psychological biases, including herd behavior and overconfidence, drive collective investor sentiment away from rationality, leading to significant asset mispricing. In other words, we see a stock rising and our brains automatically assume it's a quality company. But here's what behavioral finance research from 2025 reveals. During risk-on market rallies, companies with negative earnings have actually outperformed profitable peers. In US small caps, unprofitable firms outperformed profitable companies by roughly 20% since Liberation Day in 25. Think about that. The market rewarded companies losing money more than companies making money. That's not rational analysis, that's pure psychology. Let me show you why confusing stock price movement with company quality is one of the most expensive mistakes you can make. Let me give you two perfect examples of how share price can skyrocket while the business burns cash. Example 1, Peloton. During the pandemic, Peloton's stock soared, hitting a PE ratio peak of 581. The company was poster child for home fitness. But look at the earnings reality. Peloton has posted negative earnings per share consistently. As of March 25, the company reported diluted EPS, earnings per share, of negative 40 cents for the trailing 12 months. By April 26, Peloton's PE ratio remained at negative 40.5, meaning the company is still unprofitable. Yet, during certain periods, investors were willing to pay more than 500 times earnings for the company, and it's losing money. The stock has collapsed from those heights, but the lesson is clear. Price momentum convinced investors to ignore the fundamentals. Second example is WeWork. This one is even more dramatic. It reached a peak private valuation of about $47 billion in January 2019. The company was valued higher than Boeing and Ford. But when the IPO prospectus was filed in August 2019, reality hit. WeWork had lost $1.6 billion on just $1.9 billion in revenue in the first half of the year alone. The company had $18.6 billion in liabilities and had never been profitable. Within weeks, the valuation collapsed from $47 billion to $8 billion. That's an 83% wipeout. By November 2023, the company filed for bankruptcy. In both cases, share price told investors one story, the financials told the truth. Here's what you need to understand. Stock price is a bet on future cash flow, not a report card on current performance. According to research from Pacer ETFs, while the top quartile of high sales growth companies in the S&P 500 often underperformed overall, those with top-tier free cash flow margins within this group delivered positive relative return. Meanwhile, high-growth companies with weak cash flow generation in the bottom tier of the free cash flow margin tended to significantly lag. Translation: revenue growth means nothing if you're not generating cash. Russell Investments call this the quality paradox, when strong fundamentals are ignored in the rush of risk. The Investment Banking Council of America highlights that extreme market sentiment, measured by Fear and Greed Index, is a significant predicator of volatility. During bull runs, greed exposes investors to speculative risk, driving prices far beyond what fundamentals justify. WeWork is the ultimate case study here. The company invented a metric called community-adjusted EBITDA that excluded building and community operating expenses, essentially removing the cost of running offices from its measure of profitability. This was called perhaps the most ridiculous, insulting metric in the history of finance, yet investors bought it until they didn't. Here's the bottom line that every investor needs to tattooed on their brain. Companies do not fail because they run out of ideas, they fail because they run out of money. WeWork had plenty of ideas, expanded to 111 cities, build community, elevate consciousness. What it didn't have was positive cash flow. The company signed long-term leases averaging 10 to 15 years and offered short-term subleases month to month. This created a massive duration mismatch where tenants could walk away during downturns while WeWork remained locked into billions of dollars in lease obligations. The result? WeWork lost money every single year of its existence. And in every year, it lost more than the year before. Even as revenue grew, that is the hallmark of fundamentally broken economics. Now, contrast that with what PACER ETF research shows. Companies with high free cash flow margins not only deliver better returns, they actually maintain faster forward 3-year sales growth. Disciplined financial management reflected in robust cash flow generation can coexist with and even support accelerated growth. So what should you do? Stop using stock price as a proxy for quality. Instead, focus on fundamentals that actually matter. Is the company generating positive free cash flow? Are margins improving or deteriorating? Does the business model have sustainable unit economics? Remember, in 2025, unprofitable companies outperformed profitable ones by 20% in small caps. But history tells us these low-quality rallies do not last. When sentiment shifts, and it always does, investors who confuse price momentum with business quality get crushed. Don't be one of them. Follow the cash, not the crowd.